This is the last part of the accounting exam, which I'm going to go through, section D. It talks about criterion 4, which is decision making. So what you'll find is 3 questions. So question 8 is where you have to calculate ratios. Question 9 is use financial information and ratios in order to analyse that performance and make some recommendations. So that's the harder part of this criterion 4. And then in question 10, you have to analyse either cash budget or cash flow statement and make some recommendations. Now, the way that this is structured in section C, you either have to prepare a cash budget or cash flow statement. So if it's a cash budget, then you then interpret a cash flow statement in question 10, and vice versa, and that's how it's been operating from year to year. So let's make a start. In relation to section C, these are the types of ratios that have been asked in the past, but there's obviously a lot more ratios that can be asked. For example, the quick assets ratio, the equity ratio, and the return on total assets. But I'm just going to work through these ones that have been presented in the last 2 years' exams as an example. So let's have a look at the first question of the 2017 exam, question A. So what it's asking you is to calculate the current ratio. That's the formula which you will be given on a formula sheet. You obviously would need to find your current assets and current liabilities. Sometimes they're given to you, and sometimes you will be presented with a balance sheet where you have to calculate the total current assets and current liabilities. But when you divide one into the other, you'll find that current assets outnumber current liabilities ratio of 1.82 to 1. Now, another thing that hopefully you've been told is that the desired level is 2 to 1, so that's where a business would feel comfortable in repaying its debt to be in that position. So in this instance, it's less than 2 to 1, which means the liquidity or the ability to repay debts in the short term is not its desired level, but still they would get by with that. Question 8b, talking about the solvency or the debt ratio, which is looking at longer term financial stability. And there's your formula, which again you get from the ratio sheet. In this instance, in this question, you had to calculate what the total liabilities were, the total current liabilities and total non-current liabilities. You take the total liabilities, divide them by the total assets. Again, on your sheet you would have seen reference to current assets, non-current assets, and they add them together, and you get 40%. So in terms of where that should be, it's ideally that the range for gearing ratio, or the debt ratio, should be between 20 and 50%, and so therefore within that range means that the longer term financial stability or solvency is stable. The next question, 8c, you had to work out the rate of return on owner's equity. That was quite easy. You got the net profit, divide that by average owner's equity of 219. That was given to you. But sometimes you are given 2 periods of owner's equity. You have to then average those out and put that in. The answer here is 50%. The yardstick or the benchmark that I give people is that anything above 15% is good, and therefore you have to say that this particular business is profitable. Now, if you think about the benchmark I've given you, is that you can take your money and put it in the bank, you can get 2%, 3% in today's rates. If you put it into good yielding dividends, you might get 5 or 6%. So taking a risk going in business and it's not the same case for all businesses, but 15% is a rough guide. So therefore you can say in this instance it's profitable. Turning to question 8 of 2017, and again I'm going to go through calculating some ratios. So in this instance you had to work out what your gross profit ratio is. There is the formula to actually calculate your gross profit, because you weren't given the gross profit and you had to go for the income statement to work out what it was. So sales less sales returns, giving us minus the cost of goods sold, giving us a gross profit of 150,300. So there is our ratio that we need to apply. When we calculate it out, it's 65%. It means that the markup on our cost of sales, 150,300, is 65%, which is quite reasonable, but it's very difficult to make a judgment if you don't know what the industry is and what the industry average is. Right? So 65% may sound okay, but it really depends on the industry and also the economic conditions at the time. In this instance, you also had to calculate the net profit. So in this exercise, you weren't given net profit, so you had to take your gross profit and take away the other expenses that were given to you, admin expenses and so forth. So when you calculated that, you got a net profit of 32,300. Put that into the formula, and you get 32,300 divided by 23102, and you get close to 14%. Again, that is relevant to the industry and the economic conditions, so it's very difficult to make a judgment on its own. But in terms of a horizontal analysis, you might be comparing this figure to another period, or indeed you might be comparing it to the industry average, so therefore then you have more to say. 8b, talking about the rate of return on owner's equity. We've done that once before. In this instance, we were given this information, and I think in terms of the average owner's equity, we had to calculate the average owner's equity based on information that was given, which was 580,000 plus 610,000 divided by 2. So the average is obviously 595. So that's the average that I calculated there. Do your calculations, and we get 5.43%. So based on what I was saying before, it's less than 15%. It's not that crash hot really, and why take the risk in going in the business when I can probably get 5.43% if I invest in high yielding shares? So you could make that comment if you asked to. In section D, we'll also look at question 9, and you have to be prepared to make comments on all of these type of ratios. In what I'm going to talk about now, I'm going to look at the question from the 2017 exam, question 9. So in that you're given income statement summary, not the full income statement, the balance sheet summary, and they've calculated some ratios already for you. So this question is designed more for you to make comments and make some recommendations. So for question A, you had to talk about the management effectiveness for both the inventory turnover and debtors collection period. Okay. So when we look at the data, we can see that the debtors collection period in 2015 was 76 days. It's barely changed, but importantly, it's way above the industry average, and that's quite alarming. For inventory turnover, the turnover decreased, which again is not good. So for the inventory turnover, and it's 6 times for the industry average, so it's way below. Okay, way below. So that's what you could say there. So it's quite simple, but you obviously need to know that a lower turnover is not that favourable, and the fact that they're below the industry also is cause for concern. So how can we improve this one? You asked for 2 suggestions. I've given you a whole range here, some of which you would have already done in other questions, but on a accounts receivable side, with the debtors collection turnover, so you can give a discount for people to pay back their debts quicker. You have a stricter credit policy, so in that policy it might have something about charging interest and overdues. It might ask the applicant to provide financial statements. There's a whole range of other things that can be included in the credit policy, so you're a bit stricter about who you give credit to and under what conditions. Factoring is where you look at your accounts receivable and say, okay, who is owing us from 0 to 30 days? Who's owing amounts of money from 30 to 60? So 30 to 60, obviously you've got to start doing something and contacting those clients, and then sometimes you have people who pay really late, and you need to have strategies in order for them to pay quicker. Okay, you can improve inventory turnover by increased marketing. You can change your markup to increase your sales, or indeed you can decrease the markup to increase the amount of sales as well. It depends on the type of product that you're selling, but the overall aim is obviously to increase sales. You can have a sale to discount slow-moving stock. Another way to improve the inventory turnover is to actually hold lower levels of stock. That has other implications in terms of customer satisfaction and wanting to try on things if it's a clothing store, for example. But technically, from point of view of this question, if you want to improve your inventory turnover, if your inventory levels are lower, then you're going to turn over your inventory quicker. So 9b is talking about liquidity. So it's the quick assets and the current ratio that you look at in relation to liquidity. In this question, they're both below the industry average. There's been slight movement. The quick assets ratio went from 1.42 to 1.24, so that's a worsening. And the current ratio was still a little bit less, which is not ideal, but it hasn't really moved much. Importantly, they were both below the industry average, so again that's cause for concern. I think you should mention these desired levels to give you extra guide to make a comment about. So for the current ratio it's 2 to 1, for the quick asset ratio is 1 to 1. So it's okay for the quick assets, but for the current ratio it's not that good. So there is some question about the ability to repay debts in the long term. In practice it probably won't make that much difference, but if the trend it goes down or gets closer to the 1 to 1 for the quick assets, you probably would show some cause for concern. This is due to the high level of accounts receivable. The fact that it's also higher than accounts receivable, I think, is notable. They've got lower levels of cash and liquid assets. And liquid assets, we talk about inventory and accounts receivable as well. And the fact that we've got lower profits, which generates less cash. So they're the reasons why, the reasons for the liquidity situation. The next question, 9c, is talking about profitability. For that you have to talk about the gross profit and net profit ratio. Both went down. The net profit went down by quite a bit, and again they are both below the industry average. So on the whole it seems that this business is not being operated that well. What can they do about to improve profitability? And I've got a whole range of stuff here. Marketing to increase sales. You could increase markup, but invariably also you could decrease markup. It depends on how elastic or responsive your customers are to price changes. You could try and control your costs. So marketing and finance expenses in this instance were very high. I know it's contradictory to what I was saying about here, but you may change your marketing strategies. So you may go for more social media than TV advertising, so that can reduce your marketing costs. But the finance costs in terms of interest rates that interest payments are paying were very high. So they obviously could try over time to repay debt to have a lower financial expense burden. Change suppliers, they might outsource some functions to others. So in that instance, if you outsource some functions, that means that you can reduce your number of employees. In some instances, you can also change to casual employees. In a practical sense, that has got disadvantages, but from a financial point of view, they're all valuable and valid suggestions to make, which if you then explain them in context, especially in relation to the figures that were presented, then you would get full marks. Now moving on to question 10, as I said before, you have either a cash flow statement or a cash budget to analyse, and that will then alternate with what happens in section C, where you have to construct one. If you construct a cash flow statement, you then analyse a cash budget. And I think that's the pattern that's appeared so far. In relation to some questions, this is question 10 from 2016. So they're the questions there. I'm going to go through the answers one by one. So identify the sectional statement that records the negative cash flow over the period and why it is negative. So when you look at your cash flow statement, you'll find that the biggest offender here is the cash flow from financing, because we had a negative negative figure, and drawings was a big offender here. Right? So you got a loan for 22,000 and you drew it 120,000. That is nonsensical, really, but you had to identify that as the answer here. In the next question, what is the change in overall cash position since the last accounting period? So you need to look at the movement, and that's the third from the bottom is 38,500. We started with 17,900 in the negative, and that means with this extra increase of 38,000, we ended up with 20,600. Question C. Identify two actions undertaken by the business regarding non-current assets. So non-current assets gives you the clue that you've got to look at investing activities. So you see two items there. They sold some shares for 170,000 and they bought a forklift for 38,000. So it's fairly straightforward. So what can they do about it? I beg your pardon. You had to comment on the net cash position from operating activities in terms of contribution to overall cash. So when we look at that, we had 499 coming in, and the outflows were 495,000, which only gives us a 4,500 profit or surplus from operations. So if you think about that in terms of ratios, that's about 1% return on our total income as sales of 499,000. So that's really, really low. Sales are low and expenses are high, if you said that, and the cause from that will be, or the impact will be, that it's difficult to fund any other expansions or to repay debt if your operations is at low, or the funds from operations are so low. So really that's your engine room of your business, and if this continued, you'd think that the business wouldn't last much longer. Part A, use the data in the statement to suggest one course of action. Again, there's lots of things that you can do. I've given a summary here, but you could say, okay, I'm going to increase marketing or marketing strategies to increase sales. We can cut cost and wages. So wages are relatively high at 190,000. You can change suppliers to reduce payments to suppliers. So we're trying to reduce the payment to supply of 220,000. In relation to the other outflow that we had, purchase a forklift, maybe we can delay that till we've generated some more cash, or indeed lease it. Another obvious thing to do from the financing section is to reduce drawings. You could also sell other assets, and another strategy, which is a valid one to put, is to attain another loan, but it's something that you don't want to do every day, because in this instance our payment of other operating expenses, which may include interest payments, are going to get higher if we're going to get another loan. Okay, let's look at section D 2017, and as I said to you before, that's looking at a cash budget. So there are the questions, for questions 10, or the parts of that question. I'm going to go through them one by one. So you had to look at what's the estimated cash position end of the accounting period. So you just have to look at the final figure. Okay. So the final figure in the cash budget is 4,980. Right. I've given you extra information there. So we had a deficit in the 2 months of January and March, and we turned that around and had a positive figure in 4,980. In part B, in which months, in identifying which months action should be taken. So basically, in January and February, you could say it will increase receipts and payments. Or I beg your pardon, increase cash receipts and decrease cash payments, to try and do something about that. What causes of action need to be taken? So in the first instance, the business is an overdraft, and therefore we need to arrange for an overdraft. Another suggestion that you could make relating to their marketing campaign is to perhaps, this is now going into part D, I beg your pardon. So what we can do about this overdraft, if we don't want to arrange for one for the bank, we can increase sales by changing the markup, or actually increase marketing or change the marketing strategies. So we can actually, because the marketing campaign was such a big chunk of our estimated payments, maybe we can change to different strategies, or indeed delay the campaign when we've got more cash on hand. But it depends on what the situation the business is in. It may be just starting off, so it probably does make sense to put strain on the cash flow in the short term, and hopefully we get extra customers coming for the door, which then obviously increase our sales. And as I mentioned before, in relation to the overdraft, we need to arrange that if we're going to go down along this track, and it will be a prudent thing to do so. Okay, that's it. Hopefully that's been useful to you, and I wish you all the luck in the oncoming exams. See you later.